So Oak Cliff's net return to clients have underperformed the S&P 500 8 out of 18 years, and yet your returns to clients have outperformed the S&P 500 over time. And I just wanted to mention some of those numbers. I also said it in the introduction before we kicked off this interview, Bryan, but I just can't help but mention because you're too polite for you to say it yourself. But the S&P 500 since inception of Oak Cliff Capital was 494.2% for the S&P 500, and net of fees is 718.3%. So, I mean, this is just an amazing track record. So, bravo, you managed that impressive track record, and at the same time, you underperformed the S&P 500 8 out of 18 years. I'm curious to hear your thoughts on that.
Well, thank you, Stig. But we have had periods of underperformance, and those periods of underperformance have lasted for a year or more. This is not surprising. Warren Buffett gave a speech in 1984 about the super investors of Graham and Doddsville, which I would encourage your listeners to go find on the internet if they haven't already. Just Google super investors of Graham and Doddsville and read Buffett's speech and then the response by a professor at Columbia Business School where he gave the speech. And there are a couple of really interesting conclusions that can be drawn from that speech. That basically every concentrated value investor will underperform the market on an annual basis 30 to 40% of the time. It jumps out of the data. And this is data as of 1984, but you can carry this data forward and you'll find it to be true. I think it's an iron rule of underperformance. Joel Greenblatt talks about it. Warren Buffett talks about it. So here's some data, which is just fascinating. If you look at Berkshire Hathaway itself, okay, which is run by the patron saint himself, Warren Buffett. Warren has controlled Berkshire Hathaway for 57 years now, going back to 1965. And Berkshire Hathaway has underperformed the S&P 18 of those 57 years, or 32% of the time. There's that iron rule, 30 to 40%. And you could say, oh, is that a function of the fact that he's managing more and more money, making it more and more difficult for himself? And the answer would be no, because if you look at the first 25 years that he controlled Berkshire Hathaway, 1965 to 1990, he underperformed 9 of those 25 years, or 36% of the time. So I think this is a reason why concentrated value investing, while it delivers great long-term results, if it's being done by people who actually have the ability and the temperament to handle it, why a lot of people kind of lose faith with it, because you will find every practitioner of it having these periods of underperformance.
Bryan, what do you think your competitive edge is as an investor?
It's a really good question. I think it's important for an investor to know what his or her edge is. If you don't know what your edge is, you're kind of like the guy at the poker table who does not know who the patsy is. And I think there are 3 sources of competitive edge. One is analytical, one is informational, and the last one is structural. Analytical, basically, can you analyze companies better, more smartly than other people? I don't think that's a source of edge for us, at least. I mean, I think we're smart, but I don't want to claim that we're smarter than, there are a lot of smart people in the market. Informational edge, I think we have a little bit of an informational edge because we have a strategy that concentrates into a small number of companies. We can, by just dint of spending more time on each business, get more informed than other investors. If we own 11 things and we're competing with a mutual fund manager who owns 185 things, we're just going to, by dint of being able to spend 10 times as much, more than 10 times as much time on each one, we're going to glean more information. So I think we do have something of an informational edge. I think our main edge is structural. What we have is patient capital. And patient capital allows us to have a long-term time horizon. And what do I mean by patient capital? We have deliberately structured our firm to make our capital very patient. 22% of our money is ours, meaning the people on this floor who are making the decisions. And we have a lot of confidence in our work because it's our work. The 78% that is not our money, that's our clients' money, we have been very intentional about saying to them, this is a long-term game. You should expect periods of underperformance. If we send you a letter showing disappointing returns, either in absolute terms or in relative to the market. That's just part of the game. An investor with impatient capital might not want to own Charter for fear of more news stories next month about people building more fiber. They call that headline risk. It might drive the price of Charter down as people worry about more of these news releases from the fiber overbuilders. Those news stories might drive Charter's price down, and the investor with impatient capital would have to explain his poor short-term performance to his impatient clients. It might cause some of them to pull their money. We, on the other hand, because we're confident in our patient capital, might take the opportunity that Charter is presenting us with a lower share price to actually buy more because we have confidence in the physics and economics that we've studied. Physics and economics may take longer to emerge than a bunch of PR from fiber overbuilders trying to raise capital. And so having patient capital is a way to ride through that. There is much less competition waiting for the laws of economics and physics to be revealed over the long term than there is competing with investors worrying about next month's news stories. A lot of firms claim to have a long-term focus, but they don't have the patient capital that actually allows it. But a consequence of betting on these things where we think there's short-term uncertainty and maybe share price softness and long-term share price strength is that we're likely to have periods of underperformance in the short term. And I think this paradox that underperformance, a bunch of the time is the way that you get outperformance over the long term is why an estimate I've seen, just 1% of money, 1% of money invested in the stock market is invested using concentrated value. And when you tumble through those numbers, the funny thing is 40% of that 1% is invested by Warren Buffett. I find the fact that this demonstrably superior strategy is rejected by 99% of people, despite the fact that there's so much evidence, because it isn't just Buffett, it's lots of others, whether it's Bill Miller or Eddie Lampert or the Tisches or Bill Ackman. Concentration makes a lot of sense, except for it creates some underperformance issues that people don't want to deal with.
Shifting gears here, one thing I'm struggling with is to reduce my position once I build a full position, and to me that's 10%. And here I don't refer to not being able to hold on to the position if it's suddenly at 20% or even 30%, but rather that I tend to believe in a stock or I don't. So if the stock is near intrinsic value, I will consider selling the position. In other words, I'm naturally biased to a quite binary approach, if you like. And I'm not the person who would limit my exposure from, say, 8%. Now I want to lower it to 5% because, let's say, I still believe in the stock, but I have a lower conviction. Which to me is, if I don't have full conviction, I should be out of the stock. I'm curious to hear how you think about reducing your exposure.
It's decision-making with, in uncertainty, right? So you think about your position size relative to the IRR, the expected return. And there's no one right answer. I guess I have a couple thoughts on it. The first one, let's say you do all this work and you get conviction and you make something a 10% position, which would be for us a very full position, a lot of conviction. And we've got an expected IRR of 20%. And we're very happy that we've made this investment. And then we're even happier because the share price goes up by 80%. And let's say that nothing's changed about our underlying assumptions. The cash flows that we expect are still the same. We now have not a 10% position with an expected IRR of 20%. We now have an 18% position with an expected IRR of 10%. There's a Julian Robertson used to say, every day you don't sell a stock is another day you decide to buy it, right? So you have to ask yourself, if you did all that work and you saw a 10% IRR as your expected result, would you make it an 18% position? And the answer is, of course you wouldn't. You might make it a 4% position, right? And so there'd be a lot of pressure, I think, barring some other factor, which I'm not quite sure. Maybe you're going to learn something more about the business, but I think if something goes up that much and has no underlying change in what you expect it will do for you in terms of cash flow, there's going to be enormous pressure to sell it. I think the second thought is that position size also has a psychological impact. And what do I mean by that? Let's say you have a position, you do a ton of work, and you make it a 10% position, and you've got confidence it's going to give you this great 20% return, and it goes up you now have a dangerous situation psychologically, unless you're thoughtful about it. Because when an idea has made you money after doing hard work, there's a number of psychological biases that come into place that will make you like that idea more. It's very easy and quite dangerous to fall in love with a successful idea, especially because every day that you don't sell a stock is another day you're agreeing to buy it. It's very important in the investment business when you're investing with uncertainty and you're constantly trying to add to your information base to always be looking for disconfirming evidence. That's the most important type of evidence there is. Very important to figure out why you might be wrong. Come to work each day with a healthy dose of skepticism about what you believe deeply. It's harder to do this. It's harder to accept disconfirming evidence when something has made you a lot of money. There's this saying that the human mind is a lot like the human egg. Once impregnated with an idea, it's hard to get another idea in. And I think that's particularly true when it's been impregnated by an idea that's worked. It's so great to look at that name in your portfolio and think about all the happiness that it's brought you. Charlie Munger's got this expression, a successful day for him is one in which he's learned something new, but a super successful day is one in which he's unlearned something dear to him. So I think the psychology of an increased position is such you should subject it to extra scrutiny. And of course, there's the counter that if it's been a good surprise company and they're presenting you with good surprises, then you want to keep owning it. But you have to double down on your work if something's made you a lot of money and re-underwrite it.
I can't help but quote Max Planck, the Nobel Prize winner, who said that science advances one funeral at a time. And he was talking about how difficult it just is to relinquish your ideas. He made all his progressive work whenever he was young. And as he got older, he talked about how it was ironic that he was now one of those authorities that he always stood up to, and how he had so much problem. It was so difficult for him to continue his journey as a scientist as he got older, because now he, quote unquote, knew the truth. And he knew the truth that he didn't knew the truth, but it was so hard for him to get out of because it had worked for so long. He didn't have the open mind that he used to have.
The Structure of Scientific Revolutions is a terrific book, and it talks about paradigm shifts, that there'll be an area of accepted science, and then there'll be challenges, and the challengers are laughed at or not given tenure or whatever, but then suddenly there's a paradigm shift. I think that's exactly right. People don't want to give up their best loved ideas, and I think that physicists have their best ideas before the age of 25 or 30, and then spend the rest of their lives talking about it, pounding it in. And Einstein spent the back half of his life trying to disprove all this other stuff that was coming in, questioning his theories. It's very powerful, and you have to fight against it as an investor. I think there's some clear human bugs or features in the human brain that are being demonstrated in the field of physics that I think also come to play in the field of economics. You've got to constantly challenge your assumptions.
So true. And just one quick book recommendation before we go back and talk about investing here. Was Isaacson's book on Einstein. Is just a fabulous book. So I just want to leave it at that and then move on here in the outline. So I've been very excited about asking you this question. Who would you choose to manage 10 or 100% of your personal portfolio, respectively, if you couldn't choose yourself?
100%. I don't think there's anyone I would give 100% of my money to. Maybe if that were the only alternative, I'd say I have such respect for the culture of Berkshire Hathaway, just put it all into Berkshire stock and you get this diversified group of businesses with a great culture and a ton of cash. And that might be the answer. If Oak Cliff didn't exist, there's a short list of money managers I would trust with my family's money. It's basically those dozen people. And I know them all. I know some of them better than others. Some of them are good friends. I don't want to name names. They're all talented and honest people with great track records. All of them practice concentrated value investing, which is obviously a strategy I believe in. So I think I'd advise that my family hold back some amount in cash for living expenses and allocate, 10 or 15% to each one of those investors, if they were actually open to new investment at the time, which many of them are not. All of them invest in equities. Some of them focus in the US, some of them focus in non-US, but they're all coming from this place where they're sort of obsessive about businesses, and this is what they do, and they enjoy it, and it seems very clear to me that they'll do it for a long time. That would be my answer.